Good morning, and to our resource person, Dr. Loganathan, and all the participants in this credit management program, and the director of the College of Banking and Finance of the IBSL, Mrs. Godakanda, and also the coordinator, Mr. Menaka Vijayadasa. I'm extremely happy to initiate this program today because credit has become credit has. I think somebody is disturbing. Can we ask Mr. Srinath Senaratne to switch on the mic? Yeah, yeah. Thank you. And if we take the credit, I think this is the most important time to talk about credit. Never in the history of Sri Lanka, I think we have never faced a problem like what we are having today because of poor credit management. So that is at the national level. Today you are going to discuss about, learn about, starting from today, you are going to study and also be exposed to the management of credit at the institutional level as well as the personal level. We know if we take a bank, I think all our participants are senior bankers. If we take a bank, in the bank's balance sheet, the most important asset is credit. But if it is not managed properly, it becomes a toxic credit. It becomes a toxic asset. When it becomes a toxic asset, so it creates a lot of problems. So at national level, now we are facing it. And if we ask the basic question, okay, in the presence of Dr. Loganathan, I am a little bit reluctant to talk about credit because I am not conversant in the subject. Now, if we take credit, when we extending credit, we are dealing with a party whom we don't know much of. So the main problem of evaluating credit and extending it credit to ensure that we can recover it properly as expected is the asymmetric information. Why? Because we don't know when we extend the credit, we don't know the exact nature of the borrower, what his intentions are, and if he is going to borrow a project for a project, whether the project is feasible, those things we don't know exactly. That's why we need to know the mechanics of or the measures of assessing credit. Because if we don't assess the credit properly, it becomes a, I have learned from a credit management lecture from the IBSL again, we never give bad credit. All the credit we extend is good, but they turn to be sometimes bad. That's why credit management is required. So we have to assess it properly before extending the credit and also follow it up whether the money that we have extended is used properly to make sure that we will get it back as expected during the given period. Why? Because we are not giving our own money. Again, we are using the money generated by our deposits. Deposits are our liabilities. So we have to ensure we honor our liabilities properly. That's why credit management becomes a very complex subject and also interesting too, I guess. And also we are happy to offer this lecture series online, enabling the participants who cannot afford to physically attend these lectures, so they can attend from anywhere in the country at any time. And also once these are recorded and we allow the participants to read them through the YouTube, then you also will have the facility to prepare for your exams properly. So we are extremely happy. And with that, let me welcome again all of you. As a principal at the IBSL, we consider all the young bankers as the future leaders. So our motto, the motto of the IBSL is to empower the future leaders in knowledge and skills. This is part of that main program that we offer. Today, I think to offer this lecture program, the lecture series, we have a very prominent and also conversant, experienced lecture panel. Mr. Narayana, Dr. Loganathan, Mr. Asanka Liyanage, Mr. A.R. Navas and Mr. Kristina Naikara, and also Mr. M.C.V. Rajanathan and also Mr. N.U. Juman. So they will cover different aspects of credit management. You may have received the syllabus already. And with that, let me introduce our resource person today, Dr. Loganathan. There are a lot of things if you want to go in details, but Dr. Loganathan has been a very senior lecturer with a long-term association with IBSL as a lecturer. So he's an asset to us, and he has never been reluctant to offer his services whenever we requested for. Sir, thank you very much for your generosity for extending your service. And he's a consultant in project management and business development, project formation and business development, and also delivering lectures on SME financing, project financing, and lease financing. And he has started his career from the Mahagedera of the banking in Sri Lanka, that is Bank of Ceylon. And he has been a senior, hold on for a second, and chief manager, industry and leasing. And also he has provided his services to SME Bank as a consultant for project financing, and also some other organizations in the same field. He has achieved higher degrees from University of Colombo, Diploma in Economic Development, and also MBA from University of Colombo. What matters is not the qualifications, what matters is the experience and also the commitment. People can have many qualifications, but if they can't part with their knowledge and experience with the participant effectively, that is not that much relevant. Dr. Loganathan has both the academic qualifications, professional experience, and also he has a passion of lecturing. And we have received very appreciating comments from the participants. Therefore, you should be happy to start this program with Dr. Loganathan's lecture today. Sir, Dr. Loganathan, thank you very much. Let me invite him to start the project. Thank you very much. And I wish all of you a very successful program to become a very effective, resourceful credit managers of your prominent bank, not only having your services delivered in Sri Lanka, because now we have a lot of our alumni who has followed our programs. Now some of them are, a fair number of them are working abroad. So this experience will enable you to improve your professional prospects. And for all that depends on to what extent you will use this material, and also to what extent you will use the services of our lecture panel to maximize the benefits. With that, let me wish again, thank you very much, and have a very successful program. Thank you. Over to you, Dr. Loganathan.
Well, good morning to everyone, all the participants. Thank you for your presence in the following this program. Anyway, let us start now. There are modules in this program. The first module, Principle of Credit Management, Lending Policies and Best Practices. Here, today we are going to discuss Introduction to Credit, types of borrowers and business sectors. Credit. The meaning of credit. In finance, credit is granting of a loan and the creation of a debt. So that means the credit means loans and other advances. Collectively, loan and other advances, collectively we call it as credit. So that is in the financial sector. In the financial sector, credit means granting of a loan and the creation of a debt. That is credit. The term credit is applicable in another sector also, that is in commercial trade. In the commercial trade also it is. In the commercial trade, the credit is used to refer to the approval for delayed payment for purchase goods and services. Some organizations, they are selling their goods on credit to their customers on 10 installments, 12 installments, like that they are selling. For an example, Singa Sri Lanka, if you take, they are selling their goods on credit. Avans, they are selling some of their goods on credit. So there also the term credit is being used. That is for the goods. Services, if you take mobile phones, service providers, there are prepaid and postpaid. In the case of postpaid, they provide credit to the customers, mobile users using their services. So, right. So in the commercial trade also, the term credit is being used, where some organizations selling their goods and services on credit. So in both cases, whether it is financial sector or the commercial trade sector, in both cases, the credit should be managed appropriately. So that's what we call it, credit management. Both sectors, financial sector as well as commercial sector, the term, the credit is managed properly, appropriately. So that is credit management. But in this program, we are dealing with the financial sector. Sometimes I have seen some people from the commercial sector also follow this program. That also beneficial to them. That also beneficial to them. So, but in this one, in this program, diploma program, we are dealing with financial sector credit management. Right. Now we see, what do you mean by credit management? Managing provision of credit and its recovery. Managing provision of credit and its recovery. So it should be carried out effectively and efficiently. The meaning of effectively and efficiently. Effectiveness is doing the correct thing or the right thing. Efficiently means doing the thing rightly or correctly. So when you combine doing right thing rightly. So in the credit management also, the managing the provision of credit and its recovery, we must do it. We must do the right thing rightly. It should be effectively and efficiently we have to carry out. That is very important. In the inception of this program, you must keep it in your mind. So it should bring benefits to the lender as well as the borrower. Both should be benefited. We call it a win-win situation for both parties. So the credit management should bring a win-win situation to the lender as well as borrower. That also you have to keep it in your mind. Before going into the credit management proper, we just look at the history of bank lending in Sri Lanka. How the bank lending started. Though Sri Lanka is reputed to have used coinage in ancient time, that is during our king's time, there is no recorded history of banking prior to the 17th century. During our king's era, people were using coins, silver coin, gold coin, silver coin, that was there. But there was no history of banking prior to 17th century. Natukota Chettiars, a migrant business community from South India, went to many Southeast Asian countries like Burma, present Myanmar, that is Burma, Thailand, Indonesia, Malaysia, Singapore, and Sri Lanka. That time, Sri Lanka was called as Ceylon. During this period, to expand their business, that is during the 17th century, these migrant business people, Natukota Chettiars, went to many of the Southeast Southeast Asian countries. Their main business is money lending. Their main business was money lending. In Sri Lanka, they came and introduced a financial service system akin to banking, something similar to banking. They have introduced a financial service system in Sri Lanka, like other Southeast Asian countries as well. This was done during the Dutch period, and then it continued. So they started this one during the Dutch period. It continued thereafter. But they were active during the British area. Though they started in Dutch period, they were very active during the British era. They provided loans, they provided pawning services, and performed intermediate function between the British rulers and the native Sri Lankans. Even some people kept their savings also with them on trust. This happened with the Natukota Chettiars. Their intrusion, but anyway, their intrusion helped only the affluent sector of the community who had connection with the foreign entrepreneurs. So they helped mainly the affluent sector of the community who had connection with the foreign entrepreneurs. So how they have helped? Opening estate in plantation sector. They provided loan facilities, loans to the people to open estates in the plantation sector. Coffee estate, tea, rubber, coconut. So this was mainly during British period. Then at the time, with the expansion of trade with India and other European countries under British rule, many banks were set up by British business. So now the business is flourishing between Sri Lanka and India, and again with European countries. So many European banks, British banks, they came to Sri Lanka and established. In 1841, a fully British-owned first commercial bank named Bank of Ceylon was established. That was in 1841. This bank crashed in 1848 with the coffee crisis. That time, a fungal disease attacked the coffee plantation. The disease was called as coffee leaf rust. A fungal disease attacked coffee leaf rust on coffee plants in Asia, not only in Sri Lanka, in other Asian countries also this happened. So this bank, they have granted many loans to this sector. That bank crashed. Because of that crashing, and had a devastating effect on the country's economy. When a bank failed, there will be a devastating effect that will come in the country's economy. So that time the country has experienced that type of devastating effect because of this bank failure. So this was the first bank, Bank of Ceylon, first commercial bank fully owned by the Britishers, that crashed in 1848. By this time, during this time, many foreign banks were operating and involved only in foreign trade in the island. So now, so many other British banks, European banks have come to Sri Lanka. So they were operating only in the foreign trade, that is import and export sector only. They were mainly concerned. They never provided any assistance to the local businessmen or any other development activities. Some of the banks established during this period. In 1888, one bank called Hatton Bank established in the estate area, estate sector. Later, this bank converted as a joining with some other banks and branches that become as the present Hatton National Bank. Similarly, in 1920, one bank called Eastern Bank, it had a branch in Sri Lanka. That bank branch also joined with various other bank branches. That bank later came as the present commercial bank. If you want to know more about these banks, International Bank and Commercial Bank, you can go through their website. These details are given there. Right. Hence, the affected local business now, all these foreign banks, European banks, British banks, they were helping the affluent sector of the people who had, and the foreigners who had connection with the foreign entrepreneurs. So, the affected local people got affected. The affected local business community canvassed the British government for better banking facilities to expand their business, as they could not compete with British businessmen and planters. So these local people, they complained to the government, they want better banking facilities for them because they are unable to compete with the foreign entrepreneurs and the British businessmen because they had the better banking facilities for them. But the British government did not want to establish a Ceylonese bank. They didn't want. Anyway, however, Mr. George Edmund D. Silva, a member of State Council, that time it was called State Council, something similar to the present Parliament, that was State Council. For Kandy District, moved a motion in the State Council to establish a Ceylonese bank, and it was supported by many members of the council, State Council. Mr. Edmund D. Silva, for a very eminent criminal lawyer, he was working in actually very eminent at that time, very eminent criminal lawyer who was operating in Nuerelia, but he was selected as a member to the State Council from the Kandy district. He moved a motion in the State Council to establish a Ceylonese bank, and it was supported by many members of the council. Mr. S.W. Bandaranaike was there, Mr. G.G. Ponumbalam was there, so many Sri Lankan State Council members, they supported. Subsequently, so the British government couldn't do anything. So subsequently, a commission was appointed to study and make its recommendation regarding this matter by the State Council, by the British government. Chairman of this commission was Sir Sorabji Pochanawala, a reputed Indian banker. He was appointed as the chairman. Mr. Inju Jayawardena, he was appointed as the secretary. Later, he was called Desamanya Inju Jayawardena, and he was the promoter of the present Sambat Bank. So he acted as the secretary to this commission. And Mr. Pochanawala, a very reputed Indian banker, was the chair. So this commission met so many people, so many businessmen, Sri Lankan, as well as even others. And finally, they submitted their report. This commission, after its study, recommended to establish a Ceylonese bank. A Ceylonese bank. Later, so now the government couldn't do anything. Later, an ordinance number 53 of 1939 was passed to establish a local bank fully owned by the government. That was passed in the State Council. Thus, the present Bank of Ceylon was established on 1st August 1939 and commenced its banking operation to assist local businessmen and the entrepreneurs. Thereafter, the local businessmen and entrepreneurs were able to obtain very good banking services from this particular Bank of Ceylon. So this is the past history. Actually, if anybody is interested in to know this history of banking in Sri Lanka, there was a book published by Bank of Ceylon in 1980s during its 50th anniversary time. They published a book. Very eminent people have contributed to this book, and one attractive feature of this book is the banking history in Sri Lanka. was given in that book. The name of the book is Expanding Horizon. Expanding Horizon. I think almost all libraries of all banks may have this book. If you are interested, you can go through this book, Expanding Horizon. Bankers alone published this book during 1980s on their 50th anniversary celebration. They have published this book. Well, so now this is the history of banking in Sri Lanka. Next, we move on to importance of credit to emerging economies. Importance of credit to emerging economies. It is an important tool in poverty alleviation. It is an important tool in poverty alleviation. How? Let us see. You would have heard in economics the vicious cycle or poverty cycle. The poverty cycle people who do not have sufficient income. As per poverty definition, earning $2 per day, below earning $2 per day is considered as poverty. So less income. Since their income is less, very difficult for them to save. So those savings if they save only, they can invest in something and get more income. So because low saving, they are unable to invest much. So we say low investment. Their investment is low, less investment, no, low investment. Since the investment is low, again less income. So the poverty, this is the poverty cycle. Less income. So because of that, they are unable to save more, so low saving. Since they are having low saving, they are unable to invest more, so low investment. Again, less income. So to develop them, they must have savings. To develop themselves, they must have savings. Or if they don't have saving, at least some credit should be pumped. Should come. It is for the investment as well as for their consumption also, because less income means their consumption also low. So for the consumption and saving, so they must have more saving or some outside help should come in. Then, if there is some outside help by way of credit, they can invest. The investment will go up. If the investment go up, then their income will go up. When their income is go up, they can save more. So this is another cycle. So if we want to bring this poverty cycle people out of this poverty cycle or vicious cycle, you have to give a credit to them. So how this credit can come? How this credit can come? Institutional credit. Formal credit institutions, formal. Formal credit institutions. The credit institutions approved by the central bank and monitored by them, supervised by them. Formal credit institution, banks, commercial bank, development bank, finance companies approved by the central bank and monitored the activities by the central bank. Formal. Or informal. Or informal. Credit. How? Informal means rural money lenders, even traders, friends, relations, pawnbrokers, so it can come from the informal, it can come informal credit. So informal institution, informal credit institutions, informal credit institutions. Money lenders, traders, rural traders, friends, relations, pawnbrokers, etc. So the credit can come from these people. Now, even the traders, how? If you go to the rural areas, there are rural traders. When the farmer doing the cultivation, maybe paddy cultivation, they may need seed paddy, they may need fertilizer, or they may need some chemicals to control diseases. They go to this trader, buy on credit, use them in their field, get the harvest, and the harvest they have to sell it to him, the trader. So trader put some price for this harvest that produce and deduct his loan together with the interest, give them some money. They take that money, use for their consumption, and again indebted. Again they started buying even their provisions from the traders and even the agriculture inputs from the traders. So they are also eternally indebted to them. Again the vicious cycle, poverty cycle, the traders. And the rural money lenders, the interest rate is very high. Only thing from the friends and the relations, you may buy sometime interest-free loans. That also not always. So these informal credit institutions and the informal credit also very ineffective. In between, there is another credit institution, quasi credit institutions. They are neither institutional credit institution or informal credit. They are just in between. The best example, cooperative rural banks. Best example, cooperative rural bank. Now the Samurti Bank, Farmers Bank, they are not supervised by the central bank. They are supervised by the 11 departments or organizations. Now, cooperative rural bank is supervised by the cooperative department. And Farmers Bank is coming under Agrarian Services Department. They are supervised by the Agrarian Services Department, like that. So, example, cooperative rural bank, cooperative rural bank, then Farmers Bank, then Samurti, banks, etc. They are quasi-credit institutions. So they can provide the credit to enhance the investment of these poverty-stricken people. So as I told you, the informal credit is not very effective. This is also quasi-credit institutions also to certain extent they can help, and mainly the institutional credit should come. That is formal credit institutions. Formal credit institutions. Now there is a problem with this formal credit institutions. That is, their administrative cost is very high. Their administrative cost is very high. So in the case of poverty stricken people, they may need about 20,000 or 25,000 rupees loan. So when they use their officers and when their manpower and other facilities to grant this loan, 25,000 rupees to many number of poverty stricken people, it may be not cost effective for them. So they are reluctant. Apart from that, there may be default also. Instead of that one, the commercial bank, they prefer to grant a big loan to one single entrepreneur, maybe 5 million or 10 million rupees to a single businessman. Their income is more, they are more profitable rather than giving many number of small loans to these people. And most of the time, the default rate also high when they grant. So because of that one, they have developed a system, linking, or linkages. There may be some voluntary organization, call it. So there are two. What is self-help promoting institutions? Self-help promoting institutions or organizations, self-help promoting institutions. And then self-help groups. Self-help groups. The group of these poverty-stricken people or rural people may be about 5 to 6 people in a group. 5 to 6 people in a group. So, this institutional credit provider, that is formal credit institution, use either the self-help groups or self-help promoting institutions as an intermediary to provide this credit. So they provide lump sum credit to these people or either to these people. Lump sum amount. So this is linking. So there is a credit program IBSL is conducting on this matter, separate diploma program about this linkages, self-help groups, group lending. We call it as group lending. So this is by this way the institutional credit providers, that is formal credit institution, approach the poverty-stricken people by way of linkaging through some intermediaries. Either it can be directly to the self-help groups, which has about 5 to 6 people in a group. So they provide credit to that group. At a time, 2 people may get the credit. When they pay, others will obtain, others can receive the credit in the group lending program. So there will be a group pressure. When there are about 5 to 6 people in a group, when 2 people are getting the credit, if they repay only, the balance people can get the credit. So there is a group pressure also. By this way, the institutional credit providers, that is formal credit institutions, reduce their administrative costs. So they can approach. This was very successful. First, it was done in Brazil and then Indonesia and all other countries through APRAGA, APRACA, Asian Pacific Region Aggregator organization. In Sri Lanka also, it was successful. Many institutions, they adopted this concept, group credit concept, linkages, linking. So by this way, they can do it. So see how the credit is important in poverty alleviation. Okay, now, apart from that, I will erase this now. This is linking, linkages. This is linking, linkages. So one way to reach the poverty-stricken people by the commercial banks or development banks, formal credit institution, to reach them is a group concept, linking, linkages, group lending program. Another way they adopted credit scheme concepts, credit schemes. So developing a credit scheme for one particular economic activity. One popular credit scheme is the NCRCS. New Comprehensive Rural Credit Scheme. New when a commercial bank granting a loan facility to a customer, every individual is evaluated separately for whether they are capable, their credit worthiness, their repayment capacity, about the amount, various things we will learn later. They evaluate separately. But here, the lending institution have a common scheme for one particular type of people. So this is NCRCS, New Comprehensive Rural Credit Scheme for the seasonal loans, cultivation purpose, cultivation of seasonal crops. We call seasonal loans, seasonal loans, or sometimes it was used production loan. Production loan. So they set up a credit scheme where they will give eligibility criteria to receive this credit. Eligibility criteria. So they will say this person would have been not a defaulter, age and everything involved in this activity, various things they will give. Then the maximum amount they will give. Then what is the security? Oh, very normal security they will give. Maybe that's the time only it came inter-se guarantee of two other farmers. That time only it was introduced. Inter-se, so other two farmers, security, maximum loan amount. How this loan will be released? So this will be given in that scheme. So the lending bank, the bank, maybe commercial bank or development bank, they go through and within short time, they can provide credit for many number of people. So that by this credit scheme concept came in. Still, this credit scheme concept is in operation. Most of the banks are, especially this rural credit scheme, NCRCS. Actually, this concept was first started in India, and then from India, our bankers brought it to Sri Lanka. It is very successful. Not only in cultivation loan, even in dairy farming, even in poultry farming, these concepts, even in other fruit crop cultivation, so many activities. This credit scheme concept is being followed. So this is also to help the poverty-stricken people, the farmers, poor rural farmers, to help them to come out of the poverty. So I have informed you, I have told you, linkages, group lending programs, concepts to alleviate poverty, and then concept of credit scheme, that is also to alleviate poverty from the rural people. So these are all credit, the importance of credit. And then self-employment. And apart from that, self-employment loans also given individually assessed, and self-employment loans also maybe maximum of 50,000 rupees for them to start self-employment. Maybe petty traders like that, small traders like that, these loans facilities were given. So all these things to help, important tool in poverty alleviation. So when all these things are given, what will happen? By various ways, when the credit is provided to the poverty-stricken people, then what will happen? They will get more income. So they can save more savings. Then they can invest more. They can invest more, then they will get more income again. So more income, then more saving. Since they can save more, they can invest more. So because of the more investment, again they will get more income. So this will come development cycle. So converting this poverty cycle to the development cycle mainly because of credit. Mainly because of credit. Converting the poverty cycle to the development cycle is mainly because of credit. In addition, technical input also important. Technical input also. So when they provide, the commercial bank provide these services, they obtain the technical assistance from agriculture department, mine export crop department, livestock department, from various other departments, government department, to make it a success. So, but main element is credit, because other elements are available, technical inputs are available, but to purchase the technical inputs and other things, people need money. So credit is an important element. So when the banks provide credit by the various ways I have explained, so this poverty cycle will convert into the development cycle. Right. Then, because of this one, when the development cycle, what will happen? Employment creation, more and more people will be employed. Self-employment, or maybe they can work as a group. There will be more and more employment, mainly the self-employed. Then, not only that one, in various sectors, when the credit is pumped to various sectors, agriculture sector, livestock sector, even industrial sector, trading sector, what will happen? Trade expansion. Each trade, each sector will expand. Sectors expansion. When the sectors expansion, then the trade will expand. When the trade expand means internal trade as well as external, both will expand. Not only that one, then there is an urgent need for infrastructure development. So infrastructure development will come up. Even for the infrastructure development also, the credit is needed. Infrastructure development. When all these development comes up, there will be takeoff in the economic growth and development of the country. So for the development of the country, from the initial state, the credit is an important element. So which we have to provide effectively and efficiently, and it should bring a win-win situation for both the bank as well as the customers. Right. So this is the importance of credit. So when there is a question, maybe a big question or a small part of a question, short notes, importance of credit to emerging economies. You have to. And another important thing, yes, I have missed SME development. Right. Yes, here you have to include, with this one, you have to include SME development. MSME. Micro, small, medium enterprise. For this one also, you need credit. Okay. Credit should go with the technical input. The technical input, of course, you can get, but the credit is a limiting factor. The credit is an important thing. Micro development, micro enterprise, small enterprise, medium enterprise development, MSME development. So thereby employment creation, employment will create employment creation. So that also please keep it in your mind. So, SME or MSME or MSME. Right. Sources and uses of bank funds. So now, credit, importance of credit, we have studied, we have seen. The next one, to provide credit, the banks need funds. So what are the sources and how they use? Sources and uses of bank funds. The major sources, own capital of the bank. Own capital. Banks should have their own capital. Those days, of course, they didn't look at this own capital. But because of the bank failures and the depositors, borrowers affected only this payment, it became very important, and this own capital is insisted. In the case of new licensed commercial banks, new bank, if anybody want to establish from 2020, they must have their own capital, 20 billion Sri Lankan rupees. Now this is extended till 3 years. This 20 billion is extended till 3 billion. Maybe after that it may be more. In the case of license, I hope you all know, all banks, whether maybe commercial or development banks or specialized bank, they must obtain the license from the central bank. So we call them licensed commercial bank, licensed specialized bank, we call them. So all these licensed commercial banks, their initial capital requirement is 20 billion. In the case of new licensed specialized bank, their initial investment Sri Lankan rupees 7.5 billion. In the case of foreign bank who want to have their branches here, their initial investment should be Sri Lankan rupees 10 billion. So this is. Now after that, they say you will learn later. When the credit is when the expansion of credit, their capital base also should increase. With the expansion of credit and other investment, the banks have to increase their capital base. That you will learn later. Right. So these major sources, one is own capital, then the deposits from the customers, demand, savings, time deposits, foreign currency deposits, like that. Yes. The deposits also banks are getting. This is another source of funds for the bank. Then another one, apart from that, borrowed funds. Banks can borrow in funds also from various sectors, or from various people and institutions. Borrowed funds. One is a credit line, we call it credit line. What do you mean by credit line? So this is applicable to banks also. They can obtain credit lines from various sources, and banks also can give credit line to their customers. Credit lines, the banks can give credit lines to their customers. So this is credit line. So when we credit line, the lender, maybe an international or international institutions, then the borrower, if it is a national institution, maybe banks, their customer, then international institutions, maybe bank can borrow, bank. And maybe some corporates, big enterprises, corporate, also can obtain the credit line. So credit line is from a lender obtaining the facility. So it can be, the lender can be a national bank, national institution, maybe a bank or finance company maybe, or international institution. In the case of international institution, the borrower may be a bank, local bank, or big corporates, they can borrow credit line. Then the national bank, a customer can borrow. What is happening in this one? An amount is approved. Amount is approved. It will be there. And the customer can borrow, take. Customer can take the amount when they want. Amount taken, interest will be charged for the amount taken. Interest will be charged for the amount taken. And there will be a repayment period, will be there. Period will be there. There may be a grace period also may be there. During the grace period, no need to pay the capital amount, no need to pay the capital amount. So credit line concept, this is the credit line concept. There will be a lender. The type of lender can be, I have told, there will be borrower, yes. So in the credit line, an amount will be approved, a limit will be approved, and within the limit, the borrower can withdraw the money. Interest will be charged for the amount withdrawn. And there will be a repayment period, maybe or may not, a grace period. So during the grace period, the borrower has to pay the interest, no need to pay the capital amount. Once the capital amount is once the grace period is over, the borrower has to pay interest plus installment capital amount to the lender. So our local banks can borrow a credit line also, obtain a credit line also, maybe a foreign lender, international lending organization, they can borrow. That is credit line. Right. Next, borrowed fund, refinance fund. Refinance fund. In our country, the refinance funds provider is Central CBSL. Central Bank of Sri Lanka provides the refinance funds to the participating credit institutions. Provider CBSL provide to the participating credit institutions. So they approve who and who can participate in this program, the refinance program. So they refinance provided by the CBSL to important priority sector development. Best example was earlier, not now, earlier, which I have explained to you, NCRCS. New Comprehensive Rural Credit Scheme that was really promoted by the Central Bank and implemented by the commercial bank. Commercial banks, as I told you, were reluctant to provide for these special facilities to the farmers and other poverty-stricken people, because small amount of loans, many loans have to be given. That is one reason. Because of that one only, they have implemented the group lending or group linkages program. That is one way. And apart from this, in the case of NCRCS, this also many number of farmers, small amount to be provided. And the default rate also high. And the government says you have to provide these funds, provide this loan at concessional interest rate, not the usual lending interest rate, concessional interest rate. Concessional interest rate. So bank says we provide interest to our depositors. How can we give these concessional interest rate? Then the central bank told, actually the government through the central bank told, look here, you provide these funds to the farmers, loans to the farmers for this purpose. There are scheduled crops, agricultural scheduled crops. For the cultivation of these crops, you give this. We have given you this important things in this credit program, how much to give, for what crop, how is the security, how true interest guaranteed, maximum amount, all those things. Yes, we have formulated credit scheme. As per this credit scheme, you provide the loan. Concessional interest rate, you provide. After providing, you apply to us. This much we have provided. We will refinance you. We will refinance you. So you provide as per this credit scheme. which we have formulated. You provide the credit to the farmers as per this credit scheme which was formulated by us. After granting the loans, you apply for the funds. We provide you the refinance. We provide you the refinance. But this refinance should be repaid within a prescribed period, within certain period. In the case of NCRCS, it was 240 days. They have given within 240 days, whereas banks will recover from the customer maximum 6 months. Within 6 months, bank can, in the case of cultivation of paddy, the paddy harvesting may be with 3.5 to 4 months. And then farmer has to sell and everything, and farmer has to repay the bank. So farmer can repay the bank within 6 months if everything is okay. So we will give you more than 2 months more than that one, 240 days you have to repay. And we will give you at very low rate of interest. Those days the bank provided, central bank provided to the bank at 1.5% interest. And the banks were lending to the farmers at 9%. The margin was about 7.5% margin, bank said. It is a fantastic margin. But later, due to various other management problems, so yes, operation, so they scrapped this refinance for the NCRCS. Instead of that one, interest subsidy. They have introduced interest subsidy provided by the Treasury. So you give it at this rate, interest rate, so how much you are, we will provide you the balance. Balance interest we will give you. You apply and you get. So earlier, this is the refinance. But even now for the industrial development, SME development, the refinance is there from the IBSL. There is a credit line from, there are various credit lines. Credit lines from foreign institutions. Foreign credit institutions provide credit line to the government of Sri Lanka. And the government of Sri Lanka provide loans to these farmers through commercial banks, and the commercial bank has to commercial banks have to lend and then apply to get the refinance. The central bank will provide the refinance. This is still there for the SME development. This is refinance. This is another source of funds. This is another source of funds. Refinance fund. In the past, there were so many refinance programs for priority sector development. Once there was for the fisheries sector, for the agriculture sector, export agriculture sector, minor crops agriculture sector, industries, industrial development for various industries, the refinance facilities were provided. Actually, our government of Sri Lanka obtained credit lines from the various international institutions. Recently, the Japanese bank provided the credit line for the development of the MSME sector in Sri Lanka. So central bank provided, use that fund, central bank provided the credit refinance to the participating credit institutions. So this is credit line. So this is another source of funds for the bank. Bank funds. Then debenture. Debenture. Debenture is a debt instrument, we call it a debt instrument. given by the borrower. Given by the borrower. So, the borrower banks, most of the banks use this debt instrument to borrow from banks. Given by corporates. Big corporates. And who are the providers? General public. Provider of funds. The borrower of funds. Provider of the funds. The general public. So, this is an instrument in a paper. The borrower of funds, the banks and corporate, they announce the debenture issue. They announce. Generally, when a person borrow from the bank or anything, they have to provide the security, collateral. So, this borrowing of funds by the commercial banks and corporates from the general public is collateral free, without any collateral. They borrow. So they announce, they publish, they issue the debentures. And they offer a high rate of interest. That is the beauty, a generally high rate of interest. Right. Rate of interest. And they say repayment period also they will mention. Say maybe 5 years. In 5 years, we will repay you. They publish and offer the debt instrument, that is debenture, they issue, people will pay. People will give the funds. So they will get the debenture. It's an instrument in paper. This bank has borrowed from people this much of amount, repay at this rate, the interest rate, it will be repayable on such and such date. Debenture issue. So almost all banks have issued debentures and borrowed from the general public without offering any collateral. Debenture issue. Even some corporates also have issued debentures. Sometimes these debenture issues oversubscribed. They would have wanted about 800 million. It will within no time that has been achieved. Oversubscribed. This is debenture issue. So this is another borrowed fund. And then credit lines, refinance funds, and debenture issues apart from euro-dollar borrowing. This is just a borrowing, one-time borrowing from euro or dollar borrowing. So the banks can borrow from international banks, from international institutions. They can borrow in euro or dollar currencies. They borrow. So that will be facilitated by some intermediary. That borrowing can be, most of the time, HSBC has facilitated. For some of the local banks, they arrange the euro or dollar borrowing from the foreign international credit institution. That is another way, euro dollar borrowing. And finally, when they are doing the business, the retained profit, they get the profit, they retain that profit, and they can plow it back, use it. So these are the major sources. Once again, own capital, I have explained the detail of it. Then the deposit of customers, yes. And the borrowed funds, yes. And finally, retained profit. They can plow it back, the profit. So these are the major sources of bank funds. Now users, major users. This is statutory reserve ratio, that is SRR. This is, of course, with the central bank. Out of the rupee deposit the banks collected, the 4% of the deposit should be kept with the central bank on interest-free account, on interest-free deposit account, so that commercial bank won't get any interest. So this is by way the bank, central bank can control the commercial bank in their lending. If they want to reduce the lending, yes. If they want to expand the lending by way of this statutory reserve, they can control the commercial bank. Earlier it was 12% also, one time 12%. One time SSR percentage was 12%. Out of the rupee deposit commercial bank collected, they would have kept 12%. Later 11% and 10%, 9%. This is just maybe 9.5 like that. And now it has come to 4%. So when it is 12% out of the amount, they have to keep a big amount with the central bank interest free. So their lending will be reduced. When it comes to 4%, yeah, they have to keep, rather than 12%, instead of 12%, they have to keep only 4%. So their lending is increased. So this is when it is credit skews. When central bank want to reduce the credit, they increase the SSR. When they want to expand the lending, they reduce the SSR. So presently it is so sources and use of bank fund, certain percentage of the bank rupee deposit should be kept with the central bank as a deposit without getting any interest. This is one. Then another use, liquid asset reserves. Liquid asset reserve. Bank should have with them a liquid asset reserve. They should have the liquid asset in the sense cash plus treasury bill, and there are some other items also, but mainly cash and treasury bill they have to keep. And it says now it is 20% of the deposit they have to keep with them. 20%. Always they have to maintain a 20% liquid asset reserve. Why is this one? To maintain the liquidity. Why is that? When the depositors come and ask the bank for their deposit, sometime I would have kept my deposit with the bank, maybe say about 100,000 or 200,000, maybe automatic renewal. But urgently I need that money. So I have to withdraw money. When I go to the bank can't say, no, you kept it for 3 or 4 years. So you come after 3-4 years. No. When I go and demand, they have to pay me, the bank. When a customer goes and asks for his deposit, the bank should be in a position to pay. So for that purpose, it is liquid asset reserve to maintain the liquidity of the bank by way of in cash and treasury bill. All bank has to keep minimum of more than 20% of their rupee deposit. This is another use of bank money. Then the credit facilities to the customer. The balance, the credit facilities to the customers. Right. So other use, important use, credit facilities to the customer. Apart from that, the bank can keep as securities with various investment. They can buy shares of various other institutions, shares they can buy. They can create subsidiaries. They can incorporate subsidiaries. They can incorporate associate companies. They can investment. This is another important sector in banking, that is investment banking. So this is another use of the bank fund. Then fixed assets. Yeah, they need land, they need building, they may need vehicle, they may need computer system, they may need furniture and fittings. fixed assets. So these are the major uses of bank fund. Once again, major uses: statutory reserve, and then liquid asset reserve, and then credit facilities is an important use of bank fund. Credit facilities to customers, then security investment by way of shares and other investment, and finally the fixed assets. These are the sources and uses of bank funds. Now, another important thing, overview of asset and liability management, ALM in the bank. Asset and liability management is an important function. So where we can see the asset, which document we can see assets and liability, it is a balance sheet. The people who have done their accounting, they know balance sheet. In the balance sheet only you can see assets and liabilities. Hello? Hello? Here? Anything? Well, yeah. So in the bank balance sheet, you can see the assets and liabilities. So we call it active management of bank balance sheet. That is, assets and liability management is active management of bank's balance sheet. So this is practice of managing the risk that arises due to mismatches between the assets and liabilities. So mismatches, there can be mismatches. So bank also have its balance sheet. Here you have the assets and liabilities. Bank balance sheet, assets, liabilities. There should not be any mismatch. There should not be any mismatch. What are the major assets of the bank assets? What are the major bank assets? Really major bank assets, it's lending, credit facilities. Credit facilities. And then investment. We have seen banks can purchase shares, bank can incorporate a subsidiary company, bank can participate in an associate company, investment in various things they can, yes. That's it. And on the other hand, what are the liabilities? Customers' deposits. Customers' deposits. And borrowings. We have seen various borrowings, borrowed funds. We have seen. So the bank is using mainly these customers' deposits and borrowing to provide credit facilities and for their investment. So this should be matched. The customers' deposits and borrowing, those liabilities, should be matched with the credit facilities and other investment provided by the bank, that is assets. So the liabilities of the bank should match with the assets, should match with the credit facilities and investment involved. That should be managed. That should be managed. If that is not managed, if there are mismatches, then there will be risk. If there is a mismatch between these liabilities and assets, then there will be risk. Mismatch will lead to risk. Mismatch will lead to risk. Mismatch. So the Asset and Liability Committee will periodically meet and examine the balance sheet of the bank and see whether there are any mismatches. And if it is so, remedial action they take. So what are the mismatches? One is interest rate. Interest mismatches. Interest rate. Now, here they are paying interest. Paying interest. They are receiving interest. What they pay should be less than what they receive. That is obvious. What they pay should be less than from what they receive. On the other hand, what they receive should be more than what they pay. Earlier, when it is a fixed interest rate, it is easy. They may pay the customer maybe 6%, and they may charge from the customer about 10% just. So there is a margin. They can manage the administrative cost and everything. But now it is not so. Now it is variable interest rate. Variable interest rate. Or in the word floating. Floating interest rate. Chinese customers wants. Yeah, I want a variable interest rate. How often all these things they may say variable. Here also variable interest rate. Floating, other term, floating interest rate. So that should be met. So it is very important. Now because customers, different customers want different variable interest rate. How often? Yes. So that should be met. So if it is not met, there is a risk of what? Interest rate risk. There is interest rate risk. Loss, it will lead to the loss to the bank. It will lead to the loss to the bank. So because of early, of course, fixed interest rate, yes, it is managing easy. But now it is variable. Floating interest rate, managing is difficult. So they have to appropriately, they have to manage that. If it is not so, if there is a mismatch between this interest rate and this interest rate, then bank will have to lose. It's a loss to the bank. Right. And then credit. So this is interest rate risks. Then credit. Default risk. Credit risk. Credit risk. Or default risk. So default. So if a default exceeds certain percentage, the bank will, sometimes bank has to take various actions, and ultimately sometimes they have to write off. So it may lead to the loss of the bank, loss to the bank. It may lead to loss to the bank. So that also should be, what is the default rate? What is the default rate? So the Asset and Liability Committee has to monitor the default rate at various districts or branches or provinces. They have to, on the whole, the bank, what is the default rate? Well, how is the non-performing advances? NPA, non-performing advances. How can you recover? What are the actions should be taken to reduce the NPAs, to reduce the non-performing advances? They have to. Otherwise, if the default rate exceeds certain limit, the central bank limitation is there. Central bank limitation is there. If it exceeds, then what will happen? Again, loss to the bank. Loss to the bank. Then the liquidity risk. So this is credit risk or default risk. Then liquidity risk or maturity risk. This is also another important risk, really, even not only in Sri Lanka, even globally. When you see about 10 or 15 years back, there was an Asian flu, a financial flu. The Indonesian banks affected very badly. They didn't look at this maturity risk. This maturity risk or liquidity risk. They borrowed from the foreign banks short-term loans. Indonesian banks, they borrowed from foreign banks short-term loan and investment in long-term building construction. They gave loans to the customers for building of construction long-term. Mismatch. And then they underwent big problem, Indonesian bank. And finally, IMF has to come and help those Indonesian government for the Indonesian banks to come out of this problem that was famously called as Asian flu that spread Malaysia. And luckily, Singapore and Indonesia and Sri Lanka are not affected. And it went up to Japan. This is mismatch between liability and the assets. Always you must know, if it is a long-term funding, long-term facility you are providing, you must have the proper source. You should not do it with a short-term liability. You should not go for long-term asset. Right. So now, this is liquidity or maturity risk. So interest rate risk we have discussed, credit risk we have discussed, and now liquidity, maturity risk. Now the important thing, I take this as an example, housing loan. Housing loan. People are going for housing loan. There's many people are going for that. There is a good demand for housing loan now. And housing loans are generally long-term loans. Depending on age, even for the retired people, they are giving loans up to 70 years of age, housing loans. So maybe generally 20-25 years. Loan repayment period, generally 20-25 years, and the big amount, maybe 5 million, and then even in the case of big business people, it may be around 50 million also, like that. It's going on. How can you finance this long-term big loan from your liabilities? How can you finance? Then, after financing, the customer comes and asks for his fixed deposit. No. ඔයාගේ fixed deposit අපි long term loan එක දුන්නා. අවුරුදු 15ට පස්සේ එන්න දෙන්නම් කියලා කියන්න බෑනේ. ඒකයි උනේ what is it? Golden Key Company. Collapsed. Golden Key Company. Collapsed. So it will lead to collapse of the financial institution. So that mismatch should be yes. So how these long-term investment on housing loan banks are doing? So one, they must see what are the long-term in assets or liability they are having with them. One is minor saving. At least when a child is born, if the parents open an account, say at the age of 1 year, at least up to 16 years, you can use that funds, minor savings account. Similarly, what are the other long-term liabilities you are having? Deposit, customers' deposit you are having with you. And other one, your own profit, retained profit, and your own capital. So you have to balance it. Your own capital you can use, retained profit is there you can use, minor savings account, children's savings account you can use. But you can use that one for giving long-term housing loan or similar loans you can give. So that should be managed properly by the Asset and Liability Committee. If there is a problem, yes, it is maturity risk, liquidity risk, the bank may collapse. When the customer comes and asks for his deposit, if you say no, not available now, then the story will spread and more customers will come. They think, yeah, this bank is going to ruin us. They will come, ask for the deposit. When everybody comes, how can you pay? You can't do it. That's what happened with the Golden Key Company. So this also properly managed. And other one, foreign exchange risk. Yes. The banks are buying, commercial banks are buying foreign currency and selling. So obviously when they borrow, they take the risk. They take the risk. So they must take the calculated risk. So sometimes foreign currency, when they buy, it is at a low rate and selling at a higher rate. If it is other way, you buy the foreign currency at a higher rate, but it happened to sell that one in the low rate, it is again lost to the bank. So that is another important risk. So all these risks will be managed by the Asset and Liability Committee. So in the Asset and Liability Committee of the bank, all senior people are there. The CEO will be there. Then DGM risk management will be there. DGM finance will be there. Similarly, all senior people comprise that committee. And periodically they meet and monitor the bank balance sheet, especially the assets and liability mismatches they will manage. This is overview of asset and liability management in the bank. Then another important thing, relationship banking. Relationship banking. What is it? Actually, the bank, I will erase this. So, if most of these things you may get as short questions, what I am explaining now, you may, and these are very important things for you to be a credit officer or the credit manager in the bank. You should know these are very basic things. These are very, very basic things. All credit officers or credit managers should keep in their mind. They should know. And if you are interested, you can get more and more information about these items. You can refer books, magazines, internet. Yeah. Financial intermediation. Banks, depositors, deposit. This is financial intermediation. So even not only banks, even other financial institutions, other finance companies, other financial institutions. They also same financial intermediation. So when we say earlier, we all were doing transaction banking. What is transaction banking? When a customer performing a simple transaction with the customer, performing a simple transaction with a customer may come to deposit his money to his account. He come, wait in the queue, go deposit the money, get the receipt, and go. Maybe a customer may come to get a foreign currency in case if he is going abroad. He come for a foreign currency. He get a foreign currency by giving all these ticket and visa and various other documents. He get that one and go. Or customer may come for a housing loan. He will come, give you will tell him these documents. Okay, he will bring and give the documents, and he will go. These are simple transactions. Simple transactions. So this happening in all these financial institutions, banks, as well as finance companies and other financial institutions. Yes, this is transaction banking. The customer will come, do a transaction, maybe depositing the money or give his check and take the money. A simple transaction, and he will go. That's all. All were doing, all these financial institutions were doing the same. That will lead to competition. Among them, that will lead to competition. It's the same thing, no? They are doing same competition. So if a finance company do better than the bank, the people may go to the finance company. Simple transaction. This will lead to the competition. So this was going on for years and years. One German bank looked at it. How can we, yes, going from this one further? How can we? So they introduced a relationship banking. Another banking. They moved out of transaction banking. They moved toward relationship banking. So this is transaction banking. They moved to relationship banking. What is relationship banking? Banks invest building in long-term relationship with the customer. Under the transaction banking, bank customer come, do the transaction, check, cash the check or deposit, and he goes. Nobody is worried. Officer will be seated there, and nobody is worried. He comes and deposit and go. Now the relationship bank invest building a long-term relationship with customer. Under relationship banking, the officers, bank officers, don't allow the customer to come and do the transaction and go. No, come, we talk. See what? Offering customers a broad spectrum of financial products and services that go beyond simple accounts or transactions to strengthen their relationship with the customer. So not just let him do this transaction and then offering customer a broad spectrum of financial products and services. Matya in the body in the Matya koide vedak karanne Matyage Paula komada lamai kiyanak inne Matyage bariyawa koide vedak karanne මේ බැංකුවේ මේක විතරයිද account තියන්නේ වෙන account සේවා නැත්ද තමන්ගේ ළමයිට account විවෘත කරලා නැත්ද භාර්යාවටත් account අපේ වනිදා ස්කීම් තියෙනවා ඒක account එක විවෘත කරන්න පුළුවන් නේද මාතයට මේ වගේ account විතර අපිත් එක්ක හොඳ මේ යනකොටම අපි loan පහසුකම් මේවා දෙන්න පුළුවන් නේද it is cross selling. It is cross-selling. Don't just allow the customer to do his transaction banking and going, and you invite him and you talk to him. Establish a long-term relationship with the customer by offering customers a broad spectrum of financial products and services that you have and that go beyond simple account or transaction to strengthen their relationship with the customer. So we call it cross-selling. Cross-selling. We are not insisting, take this loan, take a bag. We are not insisting, Matya, me loan tiyanwa gandako, araka gandako, mega gandako, nagi. This is you marketing. This is marketing. We have these products, we have these facilities. Matya, select karanda. We have these facilities. Matya ke lameta me account viruta karanda puluwa. Me viruta So you are doing cross-selling. And in this cross-selling, demographic-based products, also you can. In the case of Baisakatiya, Matya senior accounts. Badi venda, Matya ko ida veda kare, pension ko mada, pension ape banko tenwa da, Matya deposit seva tenwa na metana senior accounts apita viruta karana puluwa. Me wage very interest poli apita denda puluwa. And similarly, students, young boys, students accounts. So later, of course, when they operate the account, you can tell them, establish a relationship with them. You can obtain loan facilities for your higher education. So demographic based on population based. Demography means population based products you can offer for the seniors, for the students, for the ladies, working ladies. You can demographic based products. So when you do like this, create customer satisfaction. Customer will think, me bank hondai, me manager matya hondai, me officer hondai, ape account okkama api mehe maru karamu natham mehe viruddha karamu. Create customer satisfaction, and thereby loyalty will be created. Customer loyalty is an important thing for any organization, especially for the bank. Customer loyalty will be created through this relationship banking. And apart from that, it brings economies of scale and economies of scope in collection of customer information. Now the customer, yes, when the customer wants credit facilities, you have to collect so many information about the customer. You give the application form, you know your customer, that form has to be fulfilled by the customer, right? You are collecting the information. By this relationship, when the customer will go for the next facility, only you have to obtain the additional information. Thereby, economies of scale is maintained. So customers, all the information are with you. And similarly, economies of scope will be achieved. How is that? So not only for one particular facility, even for various, in the case of business people, they may take a business loan, they may take a car loan, they may take a housing loan. So different one. You have a collection of its information. Those information of the customer you will use for various facilities you are going to grant to the customer. This is collection of information. By establishing this relationship with the customer, relationship banking, you have more and more information of the customer with you. So again and again, you don't need to get in trouble asking, and you don't need to trouble the customer again and again asking the customer for the information, because already stock is with you. So thereby, economies of scale is maintained, economies of scope is maintained. So in collection of customer information and repeated. Apart from that one, there is transaction, repeated transaction. So again and again, when the customer is good, he will come for various facilities. There will be repeated transaction and reducing transaction cost to both. When there is a very good relationship with the customer, the transaction cost. What do you mean by transaction cost? When you grant a facility to a customer, apart from the interest charging, you are charging the interest, that is cost of your fund, but your cost of your one fund and administration cost and the profit margin, that is the lending interest rate you are charging from the customer. Apart from that, there are other costs incurred to you both, the customer as well as the banker, incurring other costs other than the interest. What are those costs? Those costs is called as transaction cost. When a customer when the facility is granted to the customer, there are other costs, maybe valuation cost, valuation fee, customer has to pay, inspection fee, customer has to pay, maybe stamp fee, mortgage, bond, drafting registration, customer has to pay. Like that. There are so many other costs incurred by the customer. If it is again and again we are troubling the customer, asking him to come to the bank, then there is non-monetary cost. Non-monetary cost. Time. Leaving his office. Or workplace. That also cost. When he is there, he will do more business. When he is not there, other man maybe do less business. So this is cost. So these are non-monetary costs. There are monetary costs, non-monetary costs in a transaction. In a transaction. So these costs of course definitely they have to be this again and again when we trouble them, yes. So reducing the transaction cost. So by this way of this, by way of this relationship banking, customers visit to the bank for a facility will get reduced because you have established a good relationship with the bank. Sorry, with the customer. So most of his information are with you. You don't need to trouble him to come to the bank again and again. Thereby his transportation cost, time and transportation cost. Time and transport will be get reduced. So it will be beneficial to the customer. Customer will be satisfied, will be happy because of this relationship banking. So when you do this effectively, when you are doing this one, other banks also will do, definitely. When your bank you are doing this relationship banking, other banks also will follow the suit. They also will start relationship banking. But who is doing very efficiently and effectively, he will be more competitive. So it will enhance bank competitiveness. When the competitiveness is enhanced, your profitability also enhanced, will increase. So you must do the right thing rightly. Relationship banking also, you must do effectively and efficiently. When you do it, your competitiveness will increase and then your profitability will increase than your competitors. So who is doing the best way? They will be benefited. This is relationship banking. Now, actually, most of the bank have for relationship bank officers or managers for their corporate customers, big customers they have. For their big customers, they have their relationship bank. But some banks, they are having relationship managers or officers for SME customers, personal customers, corporate customers. For different customer segments, they have relationship banks, relationship managers and officers. Some banks, so obviously they will do better. If they do those relationship banking in a better way, rightly and right thing rightly, then they will benefit. But some banks have only relationship managers only for the corporate customers because they are the big customers, they will bring more income to them. So this is there. So you must check with your bank what type of relationship officers or managers you have, for which customer segment you have. Right. මොනවද වැඩි පින්නුන මොනවද කියලා කිව්වේ ඒක පින් නේද? Okay, let us start. Now next one we move on to the type of borrowers and business sectors. These are all basic things as a credit officer you should know. Today what I am discussing the very basic thing you should know. I am tracing. Types of borrowers. Individuals and joint borrowers can come to you for a facility. Maybe some individual, Mr. Punjiheva and Mr. Fernando can come, or joint borrowers, Mr. Punjiheva and his son, or Mr. Fernando and his wife, joint borrowers. These are mainly for consumer credit, consumer consumption facilities, consumer credit facilities, individual and joint borrowers mainly. Or sometimes maybe a petty trading, or maybe for a small poultry farming or dairy farming, or small agriculture, they may come, this type of customers. Then a sole proprietorship customer may come. These are business customers. So they should have registered their business. Sole proprietorship should have been registered under Business Name Act number 58 of 1988. There are provincial registrar of companies. In each province, there is provincial registrar of companies. Sometimes it may be at the secretariat building, or sometimes some places it may be different places. You have to find out. That is provincial registrar of companies. In this office, you would have registered and obtained sole proprietorship registration certificate. You have to obtain. So this is sole proprietorship customers. In addition to this business registration, this is business registration, you must have a business license. Business license obtained from your local authority. That is Grama, now Pradesiya Sabha. You must obtain your business license from the Pradesiya Sabha. Annually, that should be renewed. First one, of course, the sole proprietorship, that registration once and for all. You obtain the certificate, and the business registration from the local authority, that is Pradesiya Sabha, annually you have to renew that one. Yeah, they make. Then the partnership. So the partnership, sole proprietorship is only one person name. Maybe Mr. Punjibanda. Punjibanda's trade center. Or Mr. Fernando's trade center. Trade center. That is sole proprietorship, business. Partnership. This is two or more people jointly doing the business. That is partnership. So there is partnership ordinance under the English law. Under that one, this also should be registered with the provincial registrar of companies. Partnership. So you must have the partnership registration certificate. You must have. So this partnership customers also may come. In addition, as I told you, from the local authority, that is Pradesiya Sabha, business license you must obtain. You must obtain a business license. So this is partnership customers. So once again, individual or joint borrowers may come to you. Sole proprietorships may come to you. So whatever things necessary, I have told you. Partnership customers may come to you for facility. Then the private limited liability company. Private limited liability company. So this is the minimum number of shareholders can be 1. Minimum number. Maximum can go up to 50. That is, shareholders are the owners of company. Ownership of the company, the shareholders. Then directors are managing the company, elected by the shareholders. Directors are elected by the shareholders to manage the company. So you must know the difference between directors and shareholders. Directors are not the owners of the company. It is shareholders are the owners of the company. Directors are managing the company, and they are elected by the shareholders. Right. These private limited liability companies should be registered under Companies Act number 7 of 2007. Under Companies Act number 7 of 2007, with the registrar of companies for the whole island, only one. Other provincial registrars, each province there is one provincial registrar of companies. This is registrar of companies for the whole island one. Their office is in Colombo, McCallum Road. That is Daily News. Then Jayavardhana Mahavat's new name, earlier name, McCallum Road. McCallum. Earlier Gamini Hall, just Gamini Cinema Hall, Lanka. TNA office sector. That is private limited liability company. So maximum number of shareholders, 50. They can. Anything more than 50 shareholders, then it is public company. Public limited liability companies. So even in the case of public limited liability company, there are two types. One is quoted, other one is unquoted. Quoted means in the share Colombo Stock Exchange, they have been quoted and their shares are transacted. Yes, their are transacted publicly with the other public. Public can buy and sell the shares. Public can buy and sell the shares through Colombo Stock Exchange. That is quoted. There is another name for quoted, listed company. Another name for quoted, that is listed company. And if it is not quoted, that is unquoted, their shares cannot be transacted publicly. To the public, you can't transact. Among themselves, among the shareholders, they can buy and sell their shares. That is unquoted or unlisted limited liability company. So they also can come to you. Then statutory bodies. Statutory body means, statute means is a law. Parliament law is called as statute. Then statutory body means an institution created through a Parliament Act. An institution created through Parliament Act. That is statutory bodies. A good example, bankers alone is a statutory body also. Bank as well as statutory body because it is created through bankers alone ordinance Act. Similarly, People's Bank, yes. Institute of Bankers, statutory body, there is a separate act created this institution. Standard Institute is a statutory body created through a bank act. So they also can come. They also can come for a facility. That is statutory bodies. Then government institution can come. Government departments can come. Government corporation can come. They are banking. Government corporations are banking with various banks. They can come. Government department can come. Then even the government can come. Government is coming. Government is already came. Government is can come. So on behalf of the government, it is the treasury. On behalf of the government, it is the treasury doing the transaction with the banks. Apart from that, societies can come and cooperative societies can come. Clubs, NGOs, they can come. So these are the different types of borrowers. These are the different types of borrowers. One thing, when they go to banking with you, they should have account with them. With the bank, they must have opened their accounts. To open the account, the mandates for opening account opening for mandates. So the mandate, there are different mandates for this type of customers. You must know that one. What are the requirements for these customers to open accounts? So you go through your bank documents, circular instructions. You can go through the bank circular instruction and learn what are the requirements to open accounts for these customers. This type of customer that you should know. To be a good credit officer, you must have all these things in your fingertips. I can't spend my time giving all this information. That of course on your own you can find out what are the requirements, what are the documents they have to provide for them to open accounts first of all. This type of customers. That is important thing. So type of borrowers. An overview of lending. We are providing various credit facilities to various types of customers. So we can categorized to four major categories. One is consumer credit. Consumer credit. Under that one, personal loans. Or an employee of an institution, he is drawing about 100,000 rupees salary, he can go to a bank and obtain a personal loan or motorbicycle purchasing loan. Yeah, that is consumer credit, personal loan. And apart from that, house mortgage loan for the housing, mortgage and obtaining the loan facility, that also consumer credit comes under consumer credit. Housing loan facility, that is housing loan facility, but it should be considered as a consumer credit because everything appraised or evaluated on his present position, his repayment capacity. What is his present repayment capacity? Whether he can pay this housing loan. So in the case of consumer credit, we analyze on the customer's present position, his income and repayment capacity or those things. That is consumer credit. Then the commercial credit, that is for the business. That is for the business. So that also there are two types. One is small and medium commercial loan. Other one is corporate loan. So a trader for the last 10-20 years, he is operating a small business. That is commercial credit, small commercial credit. Another little bigger commercial customer doing a business. That is also commercial credit, medium commercial credit. So large scale business organization, that depends on their capital asset value, depend on their turnover, how much is the turnover, depend on the number of employees employed by them. So these are certain criteria to decide whether an organization, institution is a corporate institution or not. Each bank will have a yardstick to select their corporate customers based on, so this yardstick based on asset value of the institution, turnover, annual turnover, or maybe monthly turnover of that institution, number of employees working in that institution. Based on that one, each bank has its measurement or yardstick to select that institution as their corporate customer. So corporate. So when you give credit facilities to this institution, we call it as commercial credit. So the commercial credit can be to small and medium commercial loans or corporate loans. Then the development credit. This is for Sangvartan, for the development of the country. Under that one, microfinance, diploma in microfinance. There's another program conducted by the IBSL. Under that one only, in my first slide, I was explaining, first or second slide, I was explaining group lending, group formation, group self-help groups, we call it self-help group or self-help group promoting institution, self-help group. All these things comes under microfinance. That comes under development credit. So there's a diploma program. IBSL is conducting separate one, diploma in microfinance. Then self-employment facilities. So for the customers to do some self-employment, the facility is providing. Then special credit scheme, I explained about the special credit scheme. About the special credit scheme, I explained. So all these things comes under development credit. Development credit, mainly for poverty alleviation program. Mainly for poverty alleviation program. And then another one, project loans. Another one, project loans. That is for micro, small, and medium enterprises. Micro, small, medium, enterprises, MSME, providing project loans. That is project loans. So that comes under development credit. And finally, international trade finance, that is for the import and export, import facilities and export facilities under international trade finance. So this international trade finance also a type of commercial credit. That also evaluation, all these things will be done based on the commercial credit. Like the commercial credit, we evaluate international trade finance, but the type of facilities differ. For the international trade finance, there are type of credit facilities we will learn later will differ. So apart from that, international trade finance also a commercial credit. So now we have four type of major credit facilities. One is consumer credit, you understand that one. Then the commercial credit, there are two types, small and medium commercial loan and corporate loan. Difference I have told you. Then development credit, then that is microfinance and poverty alleviation program, microfinance, self-employment, special credit scheme, and then project loan, SMSCs, and then finally international trade finance. Then lending to specific purposes. For what type of purposes we can lend? For what type of purposes the bank can lend? Purpose of advances. For the trade, for housing, for agriculture, for industry, for tourism, small and medium enterprises, micro enterprises, and finally consumption. These are the major purpose of advances. So you must know, you must keep all these things in your fingertip. Trade. When we say trade, what category of item will come under this trade category? Wholesale and retail. Textile wholesale business or textile resale, retail business. And import and export. Importation and exportation comes under trade. Distribution, dealership, agencies, distribution, dealership. Coca-Cola distribution or Coca-Cola dealership or Coca-Cola agency, yes. Or Highland milk powder, that is the Sri Lankan milk powder, 100% Sri Lankan milk powder, yeah, Highland milk powder. I am trying to get that one, I am unable to get that one. Anyway, so distribution of Highland milk powder, dealership of Highland milk powder, agency of Highland milk powder, yes, these are coming under trade. Then providing services. You provide technical services, you provide professional services, you provide hotels or restaurant, communication or schools. All these comes under category of trade. Technical means surveying business, or providing technical support, or maybe for the agriculture, or maybe for the industry. Some organization is providing technical support. Professional, a doctor, established doctor, last 20-25 years, having the clinic, yes, that comes under trade. Established doctor, running the clinic for last 20-25 years, when he owned a facility to expand his clinic or to purchase new equipment, technical equipment, then come under trade. And communication, yes, trade. Even schools, international school, they want a facility, maybe to purchase certain furniture, fittings, and computers or like that. Yes. Then transport, maybe public transport, buses to operate in certain routes. If the customer wants buses or customer wants commercial transport, lorries, trucks, container loads to transport goods from here to there, that comes under transport. That also comes under trade. And then contracts, various type of contracts are done by contractors, maybe a building contract or road contract or developing a land contract. The contractors, when they own facility, that comes under category trade. And then real estate, purchasing a big plot of land and big extent of land, plotting into say about 10 purchases or 15 purchases, developing and selling. If that they want a facility from the bank, that's also coming under the category of trade. This is trade category. Housing. Now the housing. Purchasing a residential property. Yeah, coming under. If you want a facility to purchase a residential property, that is housing. Purchasing a land and construction of house, if you want, comes under housing. Construction of a house in his own land, if you want some loan to put up a house in his own land, comes under housing. Renovation, extension to the houses, that also coming under housing if they own the facility, considered under housing facility. In the agriculture, paddy cultivation, vegetable cultivation, fruit cultivation, perennial. Perennial means long-term plants. Long-term plant. Perennial. Long, many years plant cultivation. That is perennial crop cultivation. Maybe banana or pineapple, that can come under fruit cultivation or even the perennial cultivation. And minor export crop, perennial cultivation, that can come under minor export crop or perennial cultivation, perennial crop. Then the plantation crop, these are tea, rubber, coconut, coffee. So these are plantation crops. Then livestock and poultry, dairy, piggery, goat farming, and then poultry farming, if they own facility, that comes under agriculture. Similarly, fisheries and aquaculture. Fisheries, yes, and aquaculture, shrimp, prawn cultivation, or crab cultivation. That's also done. That's also people are doing. Yes. And so all these things, when the customer owns facility for these purposes, that will be considered under agriculture. In the industry, so it can be small, medium, and large industries, SMEs and large. Manufacturing certain items, soap manufacturing, or food item manufacturing, like that. Then the processing of value addition, processing. When they do processing or value addition purposes, that comes under category of industry. Milling, paddy milling, yes, comes under industry. Mining, graphite mining, gem mining, if they own the facility, that will be considered under industry. Acquisition of new technology and training of staff, some institution, industry, they want to import some machinery from Japan, and that is a new technology. So they have to bring somebody to train the staff also, training the staff. If they own the bank facility, if everything is okay, if the bank is giving the facility, that is considered under the category of industry. Acquisition of new technology and training of staff, if the facility is given, that is comes under industry. Similarly, product or quality improvement. Now, bottled water. Always I see whether they are in SLS certificate. Yeah, SLS certificate is there. That says the quality of this product. You can't just get this SLE certification. You must have a laboratory. You must have the necessary equipment, periodically check the water quality, and you have to give it to the Sri Lanka Standard Institution, the results. Similarly, you have to follow it. So for that, of course, you need quality improvement. You need loan facility. If you approach the bank, if everything is okay, bank is satisfied, and then is giving, then that also considered as industry. Quality improvement. Product or quality improvement. Industry. And marketing of products. Some industry here, they want to market their products globally. So they want to open a marketing center in Dubai. They want to get an office and marketing center to promote their products. If they want the facility and you analyze and see if everything is okay, good, you can consider the facility. If you give the facility, that marketing of that product, that also comes under the category industry. So these are the various type of facilities coming under the category industry. And small and medium and micro enterprise. When we say micro enterprise, very small. Trade, petty trade, self-employment, all these are considered as micro enterprises. Trade. So in a junction, in a village junction, there is a petty kadai. So that is a trade, petty trade, micro enterprise he is doing. A lady and his family is making say swing hoppers or kotroti or roti. They sell micro enterprise, or they make murku or some other eatable item. Mixture, that type of thing. There are people, so many people, they make in a village, a family, they're making and selling micro enterprise. On the other hand, small and medium enterprises, these are new and young ventures. Small and medium commercial enterprises we have seen under commercial category. And now this is small and medium enterprises. The difference between them, that category I have explained to you, a doctor, experienced doctor for last 15, 20 years, he is conducting a clinic. He wants a loan facility to expand his clinic. He, of course, operating for last 15, 20 years. That is a commercial category. When you grant the facility, that comes under commercial category. This is a small and medium enterprise, new and young doctor, passed out. He has completed his intern, and maybe he would have worked under a doctor for about 1 or 2 years. He thought, I better have my own clinic. He is coming to you. In this place, I have found a place, I want to open up a clinic. Then you will examine how many patients you will get, how is the charger, income, and what are your expenses, how many people you will employ, all these things, whether there will be so many sick people in that area or people will get sick, you analyze and everything. If you are satisfactory, you grant the facility that comes under SME, small and medium enterprises, young and new. And after 5-10 years, this also will come as a commercial enterprise. This one will come after 5 or 10 years. This also come as a commercial enterprise. So new and young ventures, small and medium enterprises. Then the tourism. Construction of a hotel for tourist purpose, yes. Maintenance and refurbishing the existing hotel, yes. Tours and travel agent for tourism purposes, and transport, maybe good transport or passenger transport with Volvo bus, by purchasing a big Volvo bus to transport the tourists comfortably. Yeah, if you consider all these things come under tourism. Then consumption, finally consumption. Vehicle for personal use. A customer wants a motorcycle or a car. Yes, for personal use. Then customer wants household item, a washing machine, or a freezer, or refrigerator, or TV, big TV. Yes. Then educational purposes. A customer wants to send his son abroad for higher education, maybe a degree or postgraduate or whatever the education. You analyze customer's repayment capacity, everything. And if you are satisfied, if you grant the facilities, that comes under consumption. A customer wants money to give away his daughter on dowry to give away his daughter, give away in marriage, dowry. You analyze if the customer has repayment capacity, credit worthiness, and everything. You analyze. If you are satisfied, yeah, you give the money for him to give the dowry, then that is consumption. Even any others not included here also, you can put it under consumption. These are the various types of facilities banks are granting. Then finally, there is another item, just for you to just know. Branding. What is branding? Rural Gambalate, sometimes you would have seen in Gambalate, Lakinati, Arak. Kang Vadadanwa, Kang Vadagahanwa. Hot iron, they keep it. They put some the owner's initials on the arak. This is branding, hot branding. For what purpose? To identify the animal as yours. To identify the animal as yours. So brand is, what is brand? A logo. Sambat Bank, Potkalas. Sambat Bank. When you see that one, it is Potkalas. When you see BOC, yeah, it is Bank of Ceylon. And there is a two this like this way. Sometimes Ceylon Bank, Ratupata, Ceylon Bank, logo, then slogans. Bankers to the nation. Whenever you see that one, yes, you see it is Bank of Ceylon. Bankers to the nation. You see, yes. Then people with the heart, that is Ceylon Bank. I like that slogan. Then the organizational name, the names of the organization. Earlier Bank of Ceylon, now it has changed. BOC, organizational name. Then color combination, color, Bank of Ceylon, yellow color. Standard Chartered, blue and green. Whenever you see the color, you say it is here. Other Ratupata, Ceylon Bank. Like that way. So these are the brands. When you see those things, you know this is this institution. When you see this slogan, you know this is this bank or this institution. When you see this logo, yeah, it is this institution. So that is the you can identify the institution. Generally, this branding is applicable to consumer products. Those days, mainly it is applicable to consumer products. Luxo, brand, Luxo. Even in the vehicle, Toyota car, yes, that has a brand, Toyota car, brand. So these are brand. Those days, single sewing machine, a brand. People were mad about that sewing machine. Those days. So generally applicable to consumer products. So in the past, due to similarity among bank products, branding concept was not much adopted by the bank. So in the past, banks didn't adopt this branding concept for their products and services because almost all the banks provide the same type of product. Okay. Now, of course, it is different, same product, type of product, but different features. Same type of products and same type of services they were providing. Those days, almost all the banks, not almost, all the banks were providing same type of products and same type of services. Because at that one, banks didn't adopt the branding concept. Like as I told you, this transaction banking and relationship banking. They were doing transaction banking. Later only the relationship banking came. Even the relationship banking now, all are doing relationship banking, but who is doing the best way, right thing, right way, who is doing, they will have that competitive advantage, even in relationship banking. So similarly now, so in the past, due to similarity among bank products, branding concept was not much adopted by banks. But anyway, this is emotional in nature. The brand is an emotional in nature. You are emotional when you see your brand, what you like, your brand of soap or your brand of any product. Yeah, it is emotional. Tied to ideas of reputation. So that gives a reputation to that organization and the product. And also trust and quality. It ensures when you see that logo or such a brand, it will give you the trust and the quality. It is there. So that is the reason. But now what happened? That is a branding. So those days I told you the banks never adopted. But in Sri Lanka, the first bank who adopted this brand concept was Ceylon. How they adopted? They produced reward plus savings account. Almost all the banks having savings account. They don't adopt the bankers' own savings account. People's Bank savings account. Like that savings account. But the Ceylon Bank introduced it as reward plus. And they put in some lottery and selecting the customers and giving the reward. So they introduced this branding concept. Thereafter, almost all the banks have followed it up. Here again, who is doing this branding concept, right thing rightly, they will be benefited. Who is doing this, the brand concept, right thing rightly, they will be benefited. Now, almost all the banks are having this branding concept. They are adopting, following this branding concept. So because of this branding, emotional in nature, that gives you emotional in nature, tied to ideas of reputation, that brand will give reputation and trust and quality, create in the minds of the customer. And product differentiation is here. Ola soap, maybe bathroom soap, so toilet soap or washing soap. But the better soap will be there. It's a better brand, the brand image. So product differentiated. That product is differentiated. Maybe I'm not, don't misunderstand me, I'm not marketing or anything. But when you see the soaps, obviously more people are purchasing the Lux soap. And there are people purchasing other velvet soap and even Rani Sandalwood soap, Comba, those are there. But most people are buying that is product differentiation. Those people have the liking. So they think that quality of the product is good. So they have the trust. And that is reputed. So product differentiation. So thereby brand loyalty. Customers have the brand loyalty. Customers have the brand loyalty. Then this branding will bring competitive advantage over competitors of product. So in the banking also, when the bank brand is creating a reputation, it creates an emotion among its customers, and it ensures trust and quality. The bank branding that will bring competitive advantage over competitors' products to that particular bank. So the branding, when you are doing marketing, it's a marketing concept. This is a market branding, is a marketing concept. So in the banking also, you have to do marketing. You have to do marketing. One way of marketing this branding concept. So in your bank, you must do this branding concept, right thing rightly. Then only you can ensure your competitive advantage than your competitors. So this is also just for your information, the branding. As a bank employee, you must know this. Because of that one, we have given this. Okay. Now, thank you very much. My program is now this lecture program is now concluded. If you have any questions or anything. I must tell you some other thing also. I will be doing assignments. I will be giving maybe next lecture or lecture after next. I will be giving assignment. So some people, they are not taking this assignment very seriously. The assignment what I am giving always is related to the bank, especially the credit matter, and something related to the credit. So some people are not taking this assignment as very serious. I told minimum I have given the instruction, it should be typed on one page of an A4 sheet. Spacing, font size I have given. And then at the end, you must give bibliography, that is reference, and you must give. And even the headings, sub-headings also, like a questionnaire I have given. But some people, they just both sides, they type and not to the spacing or font size, and they don't follow, and they just say. So you must take it very seriously. Otherwise, actually, I can't help you. The marks will be reduced drastically. The basic thing, if you are not following, the marks will be reduced drastically. So the assignment, maybe in 1 or 2 weeks' time, I will give you the assignment. Keep it in your mind now, properly doing it. And you can discuss this about the subject matter discuss with your, you can with your other officers, your hierarchical officers in your bank. Even with the other bank, you can discuss. You can refer books, even the internet. But in the internet also, please select the suitable one. There are certain internet not suited for our car. Actually, the assignment, when you are preparing and writing the assignment, it should be related to our condition. So you just take something from the internet and put in, that may be suited to for the America or England. No, that of course no use. So you must put it something related to our condition. So please, the preparation of this assignment take seriously. Okay, right. Thank you. Thank you.